Today, Jeff is the Professor of International Business and Finance and Director of the John E. Robson Program for Business, Public Policy, and Government at Goizueta Business School. He is a professor, as we know, of international business and finance, focusing on global investing and business in the global economy. He speaks on financial and business forecasting, and he's quoted in places like ABC World News, NBC National News, and frequently on CNN. He's written 3 books, including Winning the Global Game, A Strategy for Linking People and Profits. I like the title of his 3rd book, which is called Age Smart, which sounds particularly relevant to us. Jeff has an MA and a BA in economics from Yale, a PhD in economics from MIT, and a master's degree, a PPE from Oxford. That's philosophy, politics, and economics. He was a Marshall Scholar at Oxford University. He's been consulted by governments on both sides of the Atlantic and in the Caribbean. In case he wasn't busy enough working, lecturing around the world, his charitable work includes work with CARE, Odyssey, and Project Destiny, and many economic development groups, and as a pack leader for a multicultural group of 100 Cub Scouts. Can't wait to hear about that. Jeff has been selected by the Wall Street Journal as one of 12 favorite professors in all executive MBA programs worldwide. And he's known for his unique ability to combine original and useful business content with an engaging and dynamic speaking style. Now, I personally hope that means he doesn't have a lot of graphs. Anyway, I hope not. Hopefully not too many graphs. So I know we're in a treat. We're going to have a treat here. So over to Jeff.
I want to start out by saying I'm not a very good investor, but still I'm sure a lot of you have questions about what's going on in the world of finance, since I'm a finance professor of the world of financial markets as well as the economy. And we will save plenty of time for questions. I do like graphs, unlike Jan, but mine are considered, from what I hear, very interesting because each one tells a story. And if I do a good job, I will tie that narrative in and I'll make sure I slow down and say, these are the takeaways for this graph. Again, if I was a big time investor, I'd be a lot wealthier than I am. I do own a beautiful cottage behind my house here. My main house is much bigger. You can see my cottage. But it is a strange time, I would think, to be a retired person, for instance, and wonder where do you put your money when interest rates are 0 and the stock market is very risky. So we can talk about that kind of thing. Just don't act on any advice I give. But mostly we will talk about where we are with the US economy and the global economy in the middle of a pandemic. So that's a bit of where we are going today, and there will be plenty of time for questions, as well as a number of graphs. I want to make one advertisement to give you context. Actually, two, is one of the great persons of our era, maybe one of the 2 or 3 best university presidents of the last 50 years, 50 or 70 years even. James Laney pulled together a group of us to found the Emory University Ethics Center. I was involved with that. Maybe Al Hargraves recommended me to President Laney. Through that, I got to know another co-founder, Kathy Kinlaw. I think she has a program coming up. You wouldn't want to miss that. Very interesting bioethicist. I think also a close friend of Jan Pratt. So I would like you to look for that. And it was through the board of the Ethics Center that I got to know Gretchen Schultz. So what a wonderful thing this is for me to reunite with Gretchen. But that program on sleep coming up sounds tremendous, and also Kathy's. So I would like you to stay engaged, and you may see me on future programs. The other thing is Al Hargraves is on this call. Al and John Robson. Al had been our kind of #2 dean and then became interim dean when John Robson went to Washington to become the #2 at the US Treasury Department, the Deputy Treasury Secretary. So John Robson is someone who had made his fortune in private business, worked at Emory. He had a few degrees from Yale and Harvard as our dean at Emory, and then he became the #2 person in the U.S. Treasury. So anyway, he left Emory some money. He and his wife have passed away, and now we have a John Robson program for business, public policy, and government. Because again, he was in business, he was dean of the business school at Emory, and he was in government. So Jan said I now direct that. So if any of you are interested in that interface between business and public policy, through Jan, I can let you know some of the programs we are doing. Obviously, they're all virtual, makes it much easier for you. I will probably do a program in early spring with Admiral Stavridis, friend of mine who, as many of you know, was Supreme Allied Commander of NATO. Jim Stavridis was on the short list for Hillary Clinton for vice president. She chose Tim Kaine, and he may be on some short lists, I imagine, for cabinet positions for Biden. All right, so anyway, you'll have the opportunity to, anytime you want, come in on some of my classes or just some of those programs through the Robson program. I want to thank Al Hargraves for really helping getting all of that going. So we move to the first slide now. And what we will do is we're going to talk about a time of uncertainty. I chose that topic because, you know, we don't even know, are we starting a second wave or would it be a third wave with the pandemic? Over half the states having increasing cases of COVID. The world is hitting, I think, new daily records in terms of new cases each day. I think it's record highs, mostly thanks to India and Brazil. So, you know, the world economy and the US economy are kind of on a precipice. They've definitely been recovering since the depression. I don't want to use the word recession, a true economic depression, a downturn like we haven't seen since the 1930s this past spring. They have been recovering, the US economy and the world economy, but with the inability to control the pandemic and the idiocy about wearing masks, etc., coming out of certain people who hold rallies, it's unclear where we go from here. And we're going to talk about what do you do in a world of uncertainty. This first graph I just wanted to show you quickly to give you a new perspective. Here, a yellow dot, I'll go back a second. A yellow dot represents density of population. So you can see how dense the population is on the northern tier of India, Pakistan, and Bangladesh. So again, with COVID spreading rapidly in India and fairly rapidly in Pakistan, you can see how that is a focal point for world population, and the density of population there is extreme. Within about 3 years, India surpasses China to become the most populous nation on Earth, and it only has about 1/3 of the landmass of China, Canada, and the US. We each have about the same landmass, China, Canada, and the US. So you can see why with something like the pandemic, the population density of India and really India, Pakistan, Bangladesh really could be a major, major problem. You see there is density within China as well along the coast, and there is in Indonesia. Luckily, Indonesia does not have a big spread of the pandemic, but if you look down there at Java, huge density of population. Indonesia is the 4th biggest population on Earth. The 5th big, we're 3rd biggest. 5th biggest is Brazil. If you look over to Brazil, you don't see a huge mass of land mass of population like you do in India or China, but you see some bright dots. Rio and Sao Paulo have a lot of population, and Brazil, of course, is the other place with a lot of COVID. So we've got the US, India, and Brazil as real hotspots for the pandemic, and throwing in some massive uncertainty as to how that will affect the world economy. And of course, we have cases picking up in Europe, in the UK, in Spain, and again, how that will impact the economic recovery, which we are now seeing in Europe. Again, all these open questions. So when we talk about uncertainty, let me give you, again, a summary. We were coming along with the world economy growing, but not quickly, plunged into the abyss in March and April, began to grow out of the abyss, and then, of course, right now, we don't know where we go from here. So we'll move to the first graph. And the first graph is just to give you that idea that on the top are daily new cases in the US. And what we see is it went from almost nothing. We had the big jump. We locked down. We were getting new cases down coming into June. We ended the lockdowns prematurely in Georgia. And our cases, of course, in Georgia spiked. This top graph is the US. In Georgia, things were much worse. Our second wave was stronger, earlier, more painful, and many more deaths. So the top is again, new cases, not cumulative cases. There's nothing about deaths on this particular graph. But you could see new cases in the US on the top graph really spiked in July and August. And sadly, that was here in the southern part of the US, particularly Florida, Texas, and Arizona, as you know, but also California and Georgia, and then Mississippi and Louisiana got in there. Then we did start getting a handle on things, particularly places like Arizona started taking it more seriously. People started wearing masks. Dr. Fauci had the bravery to fight against the others in the administration who were caving in. But you can see this very worrisome trend recently. The dark line is the 7-day moving average. You can see this worrisome trend of an upturn in new cases in the US. Not a steep upturn, but enough that we wonder, how will this impact A, human life, B, the economy? Will we have to lock some things down? Of course, in a purely idiotic move, Governor DeSantis in Florida decided to take away any restrictions. People could go into bars without masks and just climb up on top of each other, bars and restaurants. You can see the brilliance of that move as you see this curve turning upwards. But again, I'm a professor of global economics and global finance. I wanted you to see the lower one, which is we're not really in a second wave. We're still in a growth period of the first wave. And this looks like a graph. You would think this is the cumulative graph of cases, but it isn't. It's daily new cases. There are 300,000 new cases of COVID around the world each day. It's been rising, although in the last few days it seemed to have flattened. We'll have to see how that develops. I could send this to Kathy or someone who's going to speak in a few weeks. I could update it and send it to them if you're interested, or I could send it through Jan. Hopefully we are reaching a plateau in new cases. But as you know, the world just added 1 million deaths. I just hit a milestone of 1 million deaths. But as we look at the global economy, this is something that adds great uncertainty. What are we going to do with a global economy where not just the cumulative is becoming gargantuan, but new cases are rising so dramatically each day? Will we have to see further lockdowns in places like Israel, places like Spain, places like the UK? In other words, not just India. All right, we'll move to the next graph. We'll now move, wondering, well, what happened to economics? Well, again, with our theme today being uncertainty, where do we go from here, and what do you do about it in your life? We know that everywhere we go, there's this talk of what's going to be the shape of the economic trajectory. Will it be a V? Will it be a W? Will it be L? Will it be a U? Will it be a Nike swoosh? People often talk about a Nike swoosh or a check mark. What they mean by these things is a V is, here was an economy and it came down so quickly, but will it come back almost as quickly and get back to where it was? It meaning the amount of production, the amount of jobs, that type of thing. Will the unemployment rate go right back down low? That would be a V if we came back quickly. A lot of us think what we're getting is a Nike swoosh or a check mark. We came down quickly. We are coming up. It's been pretty steady. Maybe we'll continue to come up, but we're not going to be back in, say, 6 months to where we were, or maybe even a year. It might be 18 months till we're back to where we were. So it'd be more like a Nike swoosh or a check mark. Then there's a lot of fear of maybe what we're more going to see is a W. And this is a big fear. And that's why I started talking about COVID, not the economy. I was going to start talking about the economy until a few days ago when I realized that things are getting worse in more than half the US states and worse in much of the world with regard to the pandemic, which means we may have to see some further partial lockdowns. And this is that fear we have of a W with the economy. The economy came down, as this graph I'm going to explain is showing us. I'm going to explain the graph. We're clearly coming back up on some measures in the economy. But what if there have to be partial lockdowns? What if the economy turns down again before it finally turns up at some point, maybe after a vaccine? So a W is also called a double dip recession. Earlier, when we had problems in the mid 2000s with the housing bubble crashing, we were worried about a W. We called it a double dip. Did we have a recession? We started coming up. Will we have a double dip, another dip? So that's, I just want you to keep in mind. And that was discussed briefly in the debate. The problem is, as you know, they couldn't get into any depth on anything. But Vice President Biden wanted to talk about a fear of a K, a new idea. And Trump, started yelling. But the idea is we came down steeply. We are going up as an overall economy, almost like a V, but maybe we have a K. If you recall, Vice President Biden was saying the billionaires have gained something like $300 billion. They're richer than ever. They're richer than before we ever heard of this COVID-19. So they're going up, but for many, many people in the U.S., they're going down. It's not like they had a V. It's not like they had a recovery. So we all came down. The rich, the super rich went back up higher than ever. And that's what Biden was trying to explain about a V when the next round of yelling started. But I hope that idea of a K, a bifurcation is what they meant by the K. The rich getting richer, the ultra rich getting richer, the poor getting poorer, and the middle class a great threat. There were articles today, I think in the Wall Street Journal, about how for a number of Black women, it's a very tough situation right now in the job market. And we can discuss that, why. All right, but if you look at something called retail sales, which I show here in black, they actually were coming along growing. I started in January 2019, but it had been going for years like this, slow growth. These are monthly data, seasonally adjusted. Obviously, there's always more sales before Christmas and Hanukkah. So you're growing along, and then started down in March, and the bottom fell out in April when there were the lockdowns. And on an index where I said call it 100 at the beginning of 2019, I made it an index. It had risen to 104. The economy was growing. It fell by over 80%. Retail sales fell to 82. But interestingly, they bounced all the way back, and they're higher than ever. Well, you see, retail sales have two components. One is you go to stores and you buy retail goods. You buy clothes or sporting goods, food, that type of thing. But there's also e-commerce. So interestingly, at first we have a lockdown, all the stores close, and retail sales come way down. Even though more people are saying, I better start buying stuff online as long as stuff was available. But interestingly, now it's not just Amazon. I wish I we had thought of this, back in January, but all these companies called Overstock and Shopify and Wayfair, many of you probably know about Wayfair, all these companies where you can buy retail goods. So they are doing retail sales, but they're doing it online. So it's e-commerce. All these companies have their sales have gone up so dramatically that maybe Amazon stock price has doubled, but the stock price of some of these others, you can just look up Wayfair, Shopify, Overstock.com. Their stock prices are up like tenfold, 10 times, like from 30 to 300. Thanks, Jeff. I should have told you this in January. Yeah, I should have bought them too, but I didn't. But it gives you an idea that one reason retail sales are up even more than before the pandemic is people are going crazy buying retail goods online. But also stores reopened, some prematurely, so it led to, again, the second wave of COVID cases, but you can see the black come up dramatically. So that would make it look like the economy is a V. Well, that aspect of it is. But there's another part of the economy, which is service industries, not a sale of a retail good like my shirt, or I'm going to get some eyeglasses online, or get a mug online, or maybe go to a store and get some pens. But total personal consumption expenditures, when you think of all we consume, what we spend our money on as consumers, we spend our money on haircuts and trips to the theater and trips to sporting events. And that, of course, did not bounce back nearly as quickly. Theaters are closed. Some of us are just cutting our hair at home, that kind of thing. So there's been some bounce back in personal consumption expenditures, mostly because of the black physical goods that we are consuming. But we have not had a full bounce back in terms of services we're consuming. Paying money to go to theater services, haircut services. Maybe we're trying not to go to the dentist if we can avoid it. So dental services, excuse me. So you can see that the green is not nearly back to where it was, and it's already beginning to look like it's not rising as steeply. Maybe it will now rise, but at not as steep a path. In other words, to see how that could maybe be a Nike swoosh or a check mark. So because of e-commerce and people going crazy, there was this quick comeback in things we buy, physical things, but service industries are not fully back. And therefore, we're maybe halfway back in terms of the economic growth. Let me give you another way to look at that. In March and April, our economy lost 22 million jobs. We had maybe 160 million people working, so 22 million out of 160 million. A lot of people lost their job. About half of that is back. We've gained back about 11 million jobs over the last few months. So again, it's more like halfway back. Okay, now we'll look at the next graph. All right, one thing I was asked to talk about and we thought was a good idea is where is the world economy going amidst uncertainty? And again, there's so much uncertainty that forecasts we can maybe take them with a grain of salt. These come from the Economist Intelligence Unit. I hope many of you go to theeconomist.com every week and read articles. Many of you do, and I'm talking about the scientists on this call, the English literature professors. The Economist magazine is not the journal of economic science, for instance. It's not for academic economists. The Economist magazine is for intelligent laypersons, and politicians read it, etc. And it's worth reading. One reason I want to recommend it to you, the articles are very short, very concise. Often they have one good graph or one good reference if you want to follow up. And they have a consulting unit where they have forecasters around the world, the Economist Intelligence Unit. The Economist is owned by the same group that owns the Financial Times of London, great newspaper. It's based out of London, so I'm not bringing any US bias or my bias to it. It's just from this forecasting group at the Economist Intelligence Unit. And what we see is every economy but China. If you see China, the third one over, is suffering a steep decline in their GDP, their gross production this year, the total size of their economy. This is, of course, inflation adjusted. China took a hit, but they locked down so severely that it seemed like they got a control on the pandemic quickly, and they were able to reopen their factories and their stores, and their economy is growing. Now, one thing I have to say that's important, the latest forecast is that our economy will decline 5 or 6% this year. Remember, it grows about 2 or 3% over the last few years in a year. So 5 or 6% doesn't sound that extreme. You heard this morning that they just revised our economic change for the second quarter, which included April when the bottom fell out, and they said that our economy declined almost 32%. Most people don't understand that. That's at an annualized rate. It isn't actually that the economy in the second quarter was 32% smaller than it was in the first quarter. It was something like 9% smaller or 8% smaller or something. And they said, if it kept declining for 4 quarters, you know, if we could annualize by saying this decline compared to the first quarter, if we annualize that by saying, what if this happened for a whole year? What if it happened quarter after quarter for 4 quarters? Well, then we'd be down 32%. That's what they mean by the 32%. It's like, if we kept coming down at this rate, but we didn't. By the third quarter, clearly things turned upward, as I just showed you, you know, because we had a lockdown and we opened up. So July, August, September, we will have more economic activity than we had in April, May, June, especially with April and May with lockdown. So for the year as a whole, you're going to have the first quarter where the economy started to decline because in March we started locking down. So the first quarter was the beginning of a decline compared to 2019, more decline, big decline in second quarter, and then it turned up. So because of this turn upward in the economy, the year as a whole compared to 2019 will be down 5 or 6%. And that's similar around the world. Most of them came down steeply, but if you heard like India came down 40% in the second quarter, it really didn't mean that the economy was only 60% of what it was the quarter before. It means that if it continued coming down at an annualized rate, it would be down 40%. But still, India took a big hit, and it may need to lock down again. And that's why I started with COVID, not with the economy. They still have raging new cases of the virus. And that's also why I started on the title slide. I wanted to show you that map that shows density of population. There's that density of population in India and frankly around Mexico City and around London and around Tokyo and that whole conurbation megalopolis from Tokyo to Yokohama. So there are some places where they're at risk. Brazil, that whole Sao Paulo, huge megalopolis of over 25 million people around Sao Paulo. So there are risks in major economies, Brazil and India, and even the UK, where London and its home counties in the south of the UK are dense and has a lot of their population. Mexico, like Sao Paulo, like Delhi and Mumbai, these are cities that make New York and the New York surrounding areas look small. So these huge megalopolises, Mexico City, Sao Paulo, etc., are places where there could be further waves of COVID that could really hurt these economies. So Mexico, perhaps UK, India, we have some economies that are very big economies at risk because they have not really gotten a control on their pandemic. And neither have we, as we know. All right, that wasn't super clear, but what I am saying is the forecasts are that the economies will grow in 2021 in green, 2022 in blue, 2023 three in red. Economies are growing now. They're forecast to grow throughout the end of 2020 after the big decline, but the uncertainty is great because of this, whether you want to call it a second wave or a continuation of a first wave. The interesting thing, again, is China, by locking down so severely, did reopen its economy. It has been growing, it is growing, it will continue to grow. It's kind of an irony. The virus started there, but they didn't have a leader saying it's going to go poof in April or something like that. So they got a handle on it right away. And you can see, look at China, look at the green. Its economy is supposed to grow 7% next year. And then it'll decelerate back to what is projected to be a longer term growth pattern for China of about 5% a year. China's economy had been growing 9% a year a number of years ago. You used to hear about double-digit economic growth in China. That's in the past. In the future, it'll grow about 5% and then maybe decelerate to 4%. The first reason China will decelerate from double-digit growth is, you can only grow exponentially at a fast rate, 9% a year, for instance, so long until you're the world's largest economy. And you're already using Xerox machines. You already have brought in robotics. It's easy to copy other people's technology or to bring in machinery and accelerate and converge on their levels of production. But once you have, then you get diminishing returns when you already have robotics. Excuse me. So China will slow down because it's already adopted a lot of the technologies that were out there, but also they're an aging society. They have a huge labor force, but many of those people were born in the 1950s and the 1960s, and they'll be reaching retirement age, and they are reaching retirement age. And then they had the one-child policy, so their labor force will shrink. They don't have the young people. They will, just like much of Europe and Japan, and that's why we see low growth ahead for Japan. If you look at this graph, they had large baby booms like we did in the US after World War II, but that baby boom generation, as in the US, is retiring in Europe, in Japan, and in China. And unlike the US, where at least we have millennials, we had an echo boom. You have grandchildren. In Japan, they just had very low birth rates after the baby boom. Same thing in Europe. So they're going to have shrinking labor forces. And in China, they had the one-child policy. So they'll have a shrinking labor force. India and Indonesia did not have a one-child policy. They did not have a collapse of their birth rates either. So in India and Indonesia, in the last decade or two, the average woman has had about 3 children. So you have a couple, 2 people, 3 kids. So the labor force expands. It's not like the old days where you had a couple and they had 6 kids and they couldn't afford 6 kids. So the girls missed out on the opportunity to have education. It was terrible. The boys would have opportunity sometimes. The girls wouldn't have opportunity. It's different now. In India and Indonesia, and places like Indonesia, some of these emerging markets, even Colombia, and some places is Chile, some places in South America that are doing pretty well, even in Vietnam that's doing pretty well, in Thailand. They no longer have high birth rates, so they're able to educate their daughters and their sons, and that is a wonderful thing, but they're not like Japan or South Korea or Germany, places that have such low birth rates and have had low birth rates that they won't have a growing labor force. So what I'm saying is, as we look out to the future, India will be a focal point for business, for investing. It's going to have the world's biggest population. It's got a nice demographic profile. Not too many babies that they can't afford to educate the women, but not too few babies that they won't afford to be able to take care of their retirees. Indonesia has a similar profile, Vietnam, Colombia. So as we move to the questions, you may ask me about emerging markets, investing, that kind of thing. All right, so the final thing is the forecast. If you look at it on a world basis, it looks like people are looking for kind of the Nike swoosh, the check mark. The yellow shows came down hard in the first half of 2020, starting to come up, but basically down in 2020, and then slower growth, but a recovery 2021, 22, 23. I ordered these in descending order based on growth in 2023. By 2023, the recovery from the pandemic should be over, the economic recovery, and we see the world focus moves toward these big emerging markets of Asia, these big populous nations, India, Indonesia. And as I said, you could throw Vietnam and Thailand and some others in there as well. Canada and the US will come back, but we don't have fast growth ahead. The fact that we already are at a high level of productivity, we already use robots, make it hard to kind of catch up on technology. And we are aging, as all of you know. And our labor forces will grow in Canada and the US, but grow very slowly. And you know, we will have more people like myself retiring in the next decade. And the question is, will they, you know, will there be enough money that our Social Security will not be cut? So these are open questions for the Q&A session. Move to the next graph. Many of you probably figured, what do we do with our retirement funds, with our Emory 401k during 2020? So this starts January 1st. This is the S&P 500. Cruising along, stock market hits a new high February 19th. Before that, the number one on the graph, World Health Organization said, you know, we might have a public health emergency, but, you know, led by our president saying, nah, 10, 15 cases maximum. People kept buying stocks, and we hit a new record in February. Then it crashed, 34%. Painful, painful for many of us, including me. You know, we're told diversify your 401k and keep some of it in stocks. If you're over age 70, and particularly if you're over 80, don't have a huge percent of it in equity funds and stock funds, but have some. So that was very painful. More painful is if we said, we can't stand the bleeding. Look, every time we get our statement, we have less money here and we need it for our retirement. We better get out before the stock market keeps going down. So, of course, some people do get out on the way down or just when it starts coming up. And none of us could have predicted how fast the stock market came back. So we see that the stock market itself was a V. The economy really wasn't a V because so many service industries, like I say, are still closed down, like theater. We're still down, like I said, something like 11 million jobs in total. You can see in number 3 and number 4 on this graph, first we had lost 20.5 million jobs in April, but in March we had lost 1.5 million. And that's why I said in total we lost 22 million in March and April, but then we started adding them back. You can see on number 4, we started adding jobs back in May. And by now we've added back a little over half of that 22 million total that was lost. So we've only added back half the jobs. So again, with the economy, it's more like this down fast check mark. But the stock market was a V. And the reason, of course, is the Federal Reserve pumped so much money in to try to restore the economy and to keep the economy going. And it did restore the stock market. And again, I'll move to questions fairly soon. We can ask, how does that work? Was the Federal Reserve right to do that? What are the long-term implications? Will we have inflation? I had worked at the Federal Reserve. I taught monetary theory and policy at Yale before I came to Emory. So we could talk about the Fed in a few minutes, but clearly, if you look at number two, isn't this interesting? The day that the market hit its low, the Fed, Jay Powell, the head of the chairman of the Federal Reserve, came out and said, we are going to do whatever it takes to help the economy. We will print money. We will buy bonds. And that was when the stock market hit a low. And you could see how it jumped up so steeply by looking at this graph. So it really has been a printing money, Federal Reserve, pedal to the metal, foot on the accelerator recovery of the stock market. But then there's this bifurcation. Okay, so the stock market hit new high a few weeks ago, new all-time highs, and yet we still know there's a tremendous amount of pain out there in the economy. And the world has more new cases of COVID every day than it ever had. And maybe that's why we saw this correction in the stock market we saw over the last few weeks. Now people are really wondering, where do we go from here? Okay, we'll move to the next graph, and we'll be moving to questions fairly soon. Let me put a little flesh on what I just said. The Federal Reserve did not think, should we try to goose up the economy a little bit, kind of stimulate it here, because we just lost 20.5 million jobs in April. Should we, maybe bring interest rates down to zero and then just sit around? No. What the Federal Reserve did is they stepped out and bought over $3 trillion, not billion, $3 trillion worth of bonds. You see, banks often hold on their balance sheets, they can hold loans. See, a bank takes money in, that's deposits. You make a deposit, that's your asset, that's your wealth, but to the bank, it's a liability. They've got your money, but you can come claim it from them. So for them, it's a liability. What are their assets? What do they do with that money? What's their wealth? Well, they give loans, so they can earn interest off those loans, and they own those loans. Or they buy government bonds or mortgage bonds, and they earn interest off those. So banks own bonds and they own loans. And on the other side, they owe you because you gave them the money. You made a deposit. Well, the way monetary policy actually works, and like I said, I taught this at Yale, is if the Federal Reserve wants to stimulate the economy, it'll go to banks and say, let us buy some of those bonds that you have in your balance sheet. Let us buy some of those mortgage bonds or buy some of those government bonds, those treasury bonds or treasury bills, and we'll put money into the banking system. We'll set up reserves for you that you can then go out and loan out. So the Federal Reserve makes the resources available for banks to extend loans. This gets a little more complicated. We can get into it if you feel like it. Something called the money multiplier. There's a multiplied effect on the amount of loans banks can give if the Federal Reserve will step in and buy bonds from banks and set up the ability for banks to give loans. You see, banks have to hold some reserves at the Federal Reserve. A bank just can't give $1 billion loan. It has to hold 10% of that size, 10% of $1 billion on reserve at the Federal Reserve. It's like a reserve against a rainy day. What if the loans go bad? What would happen? The banks would run out of money, so they hold some on reserve. All right, so anyway, the Federal Reserve, its way to stimulate the economy is to either lower interest rates, and they did lower them, as you know, to essentially zero, or to put money into the banking system, to buy bonds and to put money into the banking system. And they did that in an unprecedented way. On the Federal Reserve's balance sheet, they hold bonds, and that's their wealth, and it went from 4 trillion to 7 trillion, like that. The reason I started in 2008, notice that we went from 1 trillion up to 2, and then we came along and we went up to 3, then we went along and we went up ultimately to 4.5. That's what was called QE1, QE2, and QE3. What is QE? QE is quantitative expansion, an expansion of the quantity of the money supply. The Federal Reserve, again, to increase the money supply out there, the amount of money out in the banking system, or the amount of reserves that banks can hold so they can increase loans to try to stimulate the economy. The Federal Reserve, to increase banks' ability to increase loans, to increase the quantity of credit. So they did a quantitative expansion by buying bonds. And you can see it, they did it in 3 steps, starting in 2008, because that's when the housing market crashed. That's when we had a financial crisis. That's when the stock market, by the way, lost more than half its value, when millions of people were foreclosed on their homes. So we have seen this story before, where the economy was in a terrible situation, and the stock market was, and the bond market was freezing up, and the Federal Reserve, as a lender of last resort, stepped in and bought bonds. So here they are, they're increasing bonds on their balance sheet and increasing the ability of banks to make loans. But a lot of people are calling what's happening now not QE4. We had QE1, QE2, and QE3. If you see those 3 steps up, they're calling this QE infinity, because Powell, Chairman Powell, said we're going to do whatever it takes to keep interest rates close to 0 and to keep the economy growing. And if it looks like the economy is going to slow down, we'll just keep buying bonds and printing money and trying to stimulate the economy. So this is fairly unprecedented, and we have to see where it goes from here. By the way, they're doing the same in Europe, they're doing the same in Japan, they're doing the same in Australia. I'm not criticizing the Federal Reserve. We were in a depression. We weren't in a recession where the economy's coming down. We were in a depression where it was plummeting. And this is kind of the inverse of that. While the economy was plummeting, the Federal Reserve just said no limits. And that's why we mean by QE infinity. We'll do whatever it takes. QE meaning quantitative expansion of the money supply. We will buy bonds and print money, if we need to buy those bonds. All right, now we'll move to the next graph. I am mindful of time because I know you'll have a lot of questions. But as we look at the next graph, and I'm a little slow pulling it up, here is where you are stuck. And by the way, I'm 63. I think I'm an empathetic person anyway, but I'm 63. What are we supposed to do? People over 60. We're told, don't put all your money, your wealth, your retirement funds in risky assets. And we can see how risky the stock market is. NASDAQ stocks, the technology stocks, rose dramatically during the dot-com boom in the late 90s into the year 2000. Then they fell 75%. That sounds kind of risky when I'm over 60, or here you are. Well, then the stock market rose beautifully until late 2007 during the housing boom. Then we had what I just said was the crash. Stocks, whether it was NASDAQ, the more technology-oriented stocks, or the broader S&P 500, they each lost 57%. $7 became $3. A 401k that had 700,000 in a stock index fund, that was 300,000. Now it went up to new highs after that. Hopefully people didn't sell out, but then it went up. And then what happened? As I showed, it lost 1/3 of its value, stock funds. That doesn't mean, I'm not saying you don't have any money in stocks. Imagine if we took it all out when it fell 1/3. Remember I showed you it was a V, it went back up. I'm just saying, look at the volatility. Stock market's way up. Some lost 3/4, way up. Lost 4/7, 57%. 4/7, way up. Lost 1/3, now way up. Then just lost roughly 15% over the last few weeks, up the last 2 days. So we need some money in stocks because they give us long-term growth, but they certainly are volatile. And depending on your age, often people give you that rule of thumb. Take 100 minus your age. That's how much of your 401k you should have in something that's riskier but could give you growth, like a stock fund. The rest have that in something that is more like fixed income, like the TIA fixed account. Well, that's wonderful. So let's say you're 75. Again, this is not Jeff Rosensweig talking. This is a rule of thumb that they say. 25% in maybe the CREF stock, something that will give you growth over time. But you're 75, you can't afford it in case it goes down by a third or 4/7 or 75%. Put 3/4 in fixed income, maybe a TIA fixed. Well, luckily the TIA fixed that you're in, that interest rate was kind of backward looking. It was locked in. So I think it's something like 3.5%. But as new money comes in, it's going to be lower and lower, the amount that we're getting on our fixed amount with TIAA. But look what happened. Let's say the money you have, and most of you have savings outside of just your Emory 401k. Let's say you say, I'm going to buy those 10-year treasury bonds. That's a very common thing for retirees to hold. Way back on the left of this scale in 1997, you could get 6-7% interest. This is the red. A couple of years later, still up around 6%. Then it was more like 4.5-5% for a while. Then in the last few years before the pandemic, rates really came down. You could only get about 2%, anywhere from 1.5 to 3. Suddenly, as you know, if you go out to buy a 10-year treasury bond, you get 2/3 of 1%. Now, of course, you're actually losing money, right? In purchasing power terms, in real terms, because there's inflation. So you're holding this bond, this government bond, that's paying you less than 1% interest, what we call nominal interest, the face value. But then you get, a year from now, the money you have has less purchasing power because there's inflation. Luckily, there's not a lot of inflation. Inflation is less than 2%. Maybe it's 1.7%. So maybe you get 0.7% interest on the bond, but then you lose 1.7% purchasing power due to inflation. So what we economists call the real interest rate, the inflation adjusted, after you take away the erosion of the value of your wealth due to inflation, is minus 1%. You have 1% less purchasing power next year. And if you had a 10-year bond and you held it for 10 years, you would have an erosion of your purchasing power of 1% a year. Now, you could go out and buy a 30-year government bond. That's the blue. That's paying almost 1.5% interest. It's almost paying as much as the inflation rate. So you still have a negative real interest rate, but small. Real interest rate, again, meaning, well, what about the purchasing power? Sure, I got 1.5% nominal face value interest, but my medical care is going to be more expensive next year. So many things will be more expensive next year. All right, insurance, perhaps. Now, here's the problem. As most of you know, and if not, this is the most important thing I'll say, bonds are risky. Stocks are not the only things that can go up and down in value, or gold, commodities can go up and down, or real estate can go up and down. Bonds can go up and down in value. And the longer term the bond, in other words, a 30-year bond, the blue, can go up and down in value. It's actually the wealth you have in it, much more than a shorter term bond, like the red, or the green is the 90-day treasury bill. If you say, I want to earn a decent interest rate, not that 1.45% is very good anyway, the blue, it's still probably less than the rate of inflation, but I want to earn something over 1%, I'll buy a 30-year bond. You do get a higher interest rate than a 2-year bond or a 5-year bond, but you risk capital loss, just like when you buy a stock. You might also get a capital gain. It's an inverse relationship. If interest rates in the marketplace eventually go up, then holding a bond that says, we're going to pay you the $10,000 back. Usually they're $10,000. A 30-year bond says, we're going to pay you $10,000 in 30 years. Meanwhile, we're going to pay you 1.5% interest, for instance, a year for the next 30 years. Well, if 2 years from now, or 18 months from now, or 4 years from now, interest rates go up in the market, and you can get, and people can get higher interest rates somewhere else, a bond that says on it, we're going to pay you $10,000, let's say in 26 years, if it's 4 years from now, a 30-year bond. We're going to pay you $10,000 in 26 years, and meanwhile, we're paying you 1.5%. Well, that bond that's paying 1.5% is not that attractive. When all of a sudden there's better alternatives for people's money a couple of years down the road, if there's higher interest rates a couple of years down the road. You don't want to be stuck with that bond that is only paying 1.5%. So the market sets prices on bonds every minute, just like it sets prices on stocks and gold every minute. And the price of that bond will come down. Now, the reverse has been happening. The price of bonds has been going up. If you held 30-year government bonds or corporate bonds, and you bought them years ago and you've been sitting on them, you've made a lot of money, not just the interest, but the price has gone up. Because bonds from the past that have high interest rates, that's nice to earn a high interest rate. Because if you go out and buy a new bond now, you're only going to get 1.5% interest on a 30-year bond. But what I'm saying is, I just want to say this so many times, you're going to think he's repetitive. I am for a reason. Long-term bonds, whether they're corporate bonds, mortgage bonds, municipal bonds, long-term bonds with fixed interest rates right now are very risky. You'll get your interest rate, but the price of the bond could go down. Probably not in the next year, maybe not in the next 2 years. Chances are next in the next 6 months. But could they go down in the next 3 or 4 years? They could go down a lot. Could they go up? Sure. The price of the bond could go up. You could make money. You could pay $12,000 now for a bond. Maybe it'll be worth $13,000 4 years from now. But you could pay $12,000 for a bond right now, and it could be worth $8,000 or $9,000 4 years from now, 5 years from now. I'm not saying it is going to be, but it could be. And I'm not saying could be like, there's a 10% probability. There's a non-trivial probability that a 30-year bond, whether it's a Coca-Cola bond or DeKalb County or state of Georgia or Treasury, there's a chance maybe 6 years from now that you had a significant capital loss on that bond. So be very careful. All right. Now, I think we'll show one more graph because I'm sure you have a lot of questions. I just wanted to emphasize that. And this is why it's so hard to be a retiree. Okay, well, let's invest in international bonds. There's only basically 2 types of international bonds. One's issued government bonds, one issued by countries that we consider very secure, not risky. They won't have a lot of inflation. Their currency won't come down a lot. Places like Germany or Switzerland or the Netherlands, Japan. The problem is if you look at it, their government bonds, their 10-year government bonds, for instance, and it's the same for 30-year, 5-year, 2-year, their bonds pay even lower interest rate than ours. In some cases, negative. It's like if you felt out, I would feel secure having my money in a Swiss government bond because I know the Swiss government is not going to debauch the Swiss franc, and Switzerland is a very secure place. I'll buy a bond. Great. The problem is it's a negative interest rate. So then you might say, okay, but I can't live on the US. There's the US, remember, at 0.67 interest. I'll buy a bond that has a higher interest rate. I'll buy a 10-year Mexican government bond. You can, and you get a higher interest rate. As you can see here, you get 5.8%. Or buy a Brazilian bond. I'll get 7.5%. Great. It's risky. Those bonds are not in dollars. Those bonds are issued by the Mexican government in pesos or the Brazilian government in reals. Could end up being a great investment. But what if the peso loses a lot of value? Well, yeah, you're getting a high interest, but you own something that is in 10 years is going to give you pesos, or in 10 years is going to give you real. Well, maybe those real or those pesos won't be worth as many dollars 10 years from now. Just to be clear, I'm not saying that you should not invest internationally. You should, to diversify. You shouldn't have all your eggs in one basket. The sad thing for us now is by putting eggs in our basket, we should have some eggs in US fixed income, US bonds, maybe some in international, but it's a very hard time to be a retiree. If you're going to invest in international fixed income, and you probably should as part of your basket, the problem is the safe countries that have really secure currencies like the Swiss franc, their interest rates are even lower than ours. And if you want to reach for yield, reach for higher interest, that probably makes sense, but there are risks involved. You're borrowing in currencies like the Mexican peso, or you're lending, and you're going to get paid back. So if you do want to dabble internationally, and you probably should have a stake in international fixed income and international stocks, like maybe a CREF global equities index fund through CREF, but you don't want big stakes. You want them well diversified. All right, let's move to some questions, Gray or Gretchen.
Thank you very much. That was a great presentation. We very much appreciate it. My question is, can we do the QEs forever? Can that slope keep going up forever? Or is there a ceiling on the amount of quantitative expansion that we can do? And if there is a ceiling, what happens when we hit it?
Yeah, Alex, I'm so glad you asked that, because that to me is the question of our era. It's what I've been teaching my evening MBA class, because we're in totally uncharted territory, as you're hinting, with the infinity aspect. And traditionally, economists have believed, when Milton Friedman, for instance, said inflation is too much money chasing too few goods and services. If you just keep printing money and there's all that money out there, you got this excess supply of money, but you only have a certain amount of land, you only have a certain amount of products. So you would think the value of money, if there's such an excess of it, would go down. That real things like land or gold, maybe that's why gold has gone up in value as an investment recently. People are worried about what will be the value of money. Will there be inflation in the price of assets like gold and land? And this has always been the fear of printing money, because it seems so easy. Government want to spend more than you take in tax revenue? Don't raise taxes, print money. That seems like a nice way out. And in fact, that is what we're doing. And maybe it is what we should be doing, because we may have no choice in a pandemic. But always the constraining factor is we've been afraid, as Alex says, can this go on forever? If there's all this money out there chasing the same amount of land, for instance, and gold, won't we have a lot of inflation? Inflation meaning rising prices of things. And if you're a retiree, for instance, on a fixed income, you're the one who loses out. And I think that may be why I wanted to give this talk, because we're in a world right now, as Alex said, that is the equivalent of something called modern monetary theory. It's something that has been kicking around, but mainstream economists, Republican and Democrats, economists at Emory, University of Chicago, where they're more to the right, MIT and Yale, the places where I was trained, more to the left. We all said this modern monetary theory seems crazy. What modern monetary theory is, you can run big government deficits. You don't have to raise taxes. All you do, print money. That's because the government has the exclusive right to print money. They can just print it and supply it. And most of us, Republicans, a Democrat like myself, said, that's crazy. If you print money, it'll ultimately be inflationary. But right now, the world is doing the experiment. We're seeing, can you have increased government spending without raising taxes, have deficits? Remember, we had never had a government deficit over 1.4 trillion. That was the maximum in the Great Recession. This year, it's going to be 3.4 trillion, 2 trillion more. How are we paying for it? By the Federal Reserve printing money and buying the Treasury bonds. All right, so where I'm going with this is we're in the middle of an experiment. We don't know if there'll be inflation on the other end. The reason economists, except for very few, there's a woman named, I think her name is Kelton, Stephanie Kelton, who's on Biden's board of advisors, who's the world's leading proponent of this modern monetary theory. We've been skeptical because we've always felt it seems too easy. You print money to pay all the government bills. Yeah, that's great. But what does that come out on? It comes out on, we think there's going to be all this money sloshing around and there'll be inflation. And then I keep saying to myself, well, who's hurt though? We don't raise taxes. We could have a Green New Deal. We could spend $2 trillion on a Green New Deal, not 100 trillion like Trump was making up. We could increase spending on infrastructure, increase in R&D. Why don't we just do it without increasing taxes, just print money? Well, we haven't done that because we were afraid there was inflation. But if we find out there isn't inflation, then maybe this modern monetary theory, this idea that we can have a Green New Deal and just print money, maybe that will be the way to go. And that's why this experiment is so important, because it seems like, no one loses. Well, what I'm worried about, and why I wanted to give this talk is, to me, the people that lose are probably retirees. The people that, and that's why I had that graph before, who are getting 1% on their money, less in the bank, less than 1%, less than 1%. And this experiment, with all this money being printed, this QE infinity could end up with inflation. So we could have retirees in a world where they're getting almost no income off their wealth, and yet we're moving toward a world of 2% inflation, 3% inflation. So instead of getting the old world where you could get 5 or 6% interest in a world of 2% inflation, so you could live off that 5 or 6% interest, now we're in a world where retirees will have to dig into their principal. Sorry, that was a long answer, but what I'm saying is we're all trying to figure out right now, where are we with this? By the way, the leading politician who's a proponent of this modern monetary theory of run big government deficits, have the Federal Reserve print money, was AOC and Bernie Sanders. And I'm quite liberal, that's not the issue, but the issue is, it would be nice if we could have a Green New Deal. We are in a climate crisis. It would be nice if we could rebuild our infrastructure, et cetera. It's just that I don't want people to think there will be no cost. You know, some people are saying there's no cost. We don't have to raise taxes. We'll just spend the money as a government and we'll print money. My fear is the cost comes right down on retirees.
We print some more money and pay them off.
What's that?
We can print a little more money and pay them off, but I don't want to monopolize the conversation.
That may be what happens, you know. One interesting thing, by the way, is the Social Security Trust Fund was supposed to run out in 2035. Now it's going to run out in 2031. Trump's idea, remember his idea to stimulate the economy is not have people like myself who are working. We won't pay in Social Security tax and Medicare tax for a while. That would make the Social Security Trust Fund run out even earlier. So that may go the opposite direction. Yeah, okay, other questions. Sorry for a long answer, but I want you to see this is exactly what is being discussed now in the Biden camp and in the negotiations between Bernie Sanders and Biden, for instance. We're really in a fight for the model of economics.
Hi, Jeff.
Hi, Lee.
So my cousin at Notre Dame was thinking, depending on what happens with the election, was thinking of moving to Canada. And we understand that we cannot open bank accounts in Canada. So I wanted to know your opinion on how safe is Bitcoin?
Yeah, I didn't know we cannot open bank accounts in Canada.
That's what we heard. Not easy to transfer our money to Canada. I mean, tell me if that's incorrect.
Yeah, I was going to say my first reaction is always don't believe everything you hear. But if you can't open them, you can open them in Australia, New Zealand, Denmark. There's other good places you can open your money. There are some Emory alumni, I will not name them, some of our most successful ones now living in Malta. They can open accounts in Malta. You can become a citizen, as you know, of many places like Malta, places in the Caribbean. you have to move some of your wealth in. If you have money in a 401k, you know, as long as you buy a building in Malta, a home in Malta, for instance, you can become a Maltese citizen. So if if we have a red wave, or if you happen to be a Republican on this call, if we have a blue wave, you can think about citizenship in other countries, but you can clearly put some of your wealth in other countries. You can put it in dollars or in their currency. Like you could put some of your wealth in accounts in New Zealand if you feel like their leader, who has obviously done a much better job with COVID and just about everything else, having a woman leader, you can put your money in New Zealand, your wealth in US dollars or in New Zealand dollars. You could do it in the UK, etc. So I'll just summarize by saying Bitcoin is extremely extremely risky for your wealth. Bitcoin was 100, it was 19,000, it was 3,000, it was 12,000, it was 6,000, it's 10,000. So a lot of people say, will Bitcoin become a replacement for money? It can be used for transactions, and that's one of the roles of a money. But another role of a money is as a store of wealth. And that's dangerous because some people are beginning to think of Bitcoin as it's like a money. It's like you got a dollar, or you got a yen, or you got a euro, or you got a Bitcoin. And it's a speculative item. It's like, betting on games or something. It can be used to make transactions. You can use Bitcoins to move some money from here to there, or pay for something. But never forget that Bitcoin was 100, it was 19,000, then it was 3,000, which shows that it's a terrible place for anyone over age 50 to put any of their wealth. As a store of wealth, it's just a speculative item. You might buy it at 300 and it might go to 19,000, but also you might buy it at 19,000 thinking, what if Trump wins? I don't want to hold US dollars, and Bitcoin could end up at 3,000 or 50,000. So it'll never be a money in terms of money should be stores of wealth as well as things you can use to make transactions. Okay, great. We'll take that. Thank you, Lee.
Thank you.
Great. Now take the next one.
Well, I had a question. Too many graphs, Jeff. But I had a question about the second one, the one showing the British economy going back 7%, recovering 7%, which was as much as China. And is that because it went down so far?
Yes.
And and it's not impacted by Brexit and whether or not they get a good deal?
Yeah, no, Jan, that's brilliant. I mean, one reason it's going down more than others is because I think Brexit is going to hurt their economy. And again, and I shouldn't say I think, that's the forecast, the general forecast. Brexit will hurt their economy. And also Boris Johnson, like Trump, his buddy, he didn't believe in masks. He didn't lock down fast enough.
Right.
Britain is having a resurgence of cases in London now. So their economy is doing worse in 2020, just as you said, Jan. So it looks like they're doing pretty well in 2021. They'll be coming up fast, but it's because they're coming from a deeper hole. So they still won't be in a very good place in some sense. By the way, if I can make a quick editorial, I can come back to you, Jan. 5 days before our election, they will announce the GDP for the third quarter of the US for July through September. This could be very interesting, dangerous if you're a Democrat, because it's a little bit like what Jan was talking about. You go down deep enough, you can bounce, there's some bounce back. The third quarter growth for the United States GDP will be a very big positive number. It might be as big as plus 30%. And headlines might say, this is the fastest growth we've seen since the recovery from the Great Depression, or Harry Truman or something. And what it is, again, after being down so much in April and May, except for stupid places like us who opened up too early. Other places were locked down. Of course, the economy in July, August, and September is going to be much higher than it was in April and May when it was locked down. So the mathematics of saying, well, what was it in the third quarter compared to the second quarter? And then they're going to annualize it. They're going to essentially multiply it by 4. It's not quite multiplied by 4, it's compounded. But so we might get a number like growth is 30%. And Trump is going to come out 5 days before the election and say, I am your savior. I brought the economy back. Biden would throw it back down. There'll be a W and it'll go back down. I brought the stock market back. So I wanted to warn people of this. And it is a very fortunate piece of timing for him that it's actually just, you know, if you throw something down hard enough, it's going to bounce. And that's what's going to happen. But what's going to be reported is only the upside of the bounce. So Jan, I'm sorry, I went a little bit offside, but that's, you know, that gives great insight, your idea. And Britain is not doing well. I thought Brexit was a terrible mistake.
Me too.
Oh, good.
I did want to just mention that I am a British citizen, and like Lee, I've been looking at my options for if things turn bad in November.
Yeah. Yeah.
But the other thing I wanted to ask you real quickly was, you know, talking about the impact on people, retired people. We're only talking about people that have investments. When the inflation goes up, the people that are that live at the places that Kathy Kinlaw and I were on the board, they're living on Social Security, sometimes $600, $800 a month. So those people are going to be particularly impacted. They don't have investments.
Yeah.
They only have one of the facilities is all Section 8.
Yeah.
They don't have anything but Social Security and buying power.
Yeah. Now, Social Security is, you know, is one of the few things indexed to inflation, although not very well. It doesn't really keep up with the inflation that retired people actually face, like healthcare inflation. The greater tragedy, if I may hint at my politics, is we have not raised the minimum wage. Some cities have, Cambridge or Berkeley, some states have. In Georgia, there is no state, there's no city in the nation with a lower minimum wage than Atlanta and Georgia. Some are as low, but none lower in decades. And if there's inflation, of course, it erodes the purchasing power of the minimum wage. So back to the question I was asked before as well, people do suffer when we're printing money and they're not, I think that's what you're saying too, when they're not part of the game, they're not Elon Musk.
They're not part of the game.
They're not the ones gaining from it. You know, they're not the people, there are a number of people suffering in this paradigm that we're in right now. All right, next question, but thank you, Jan.
My name is Dr. Galina. Jeff, I have a question for you. Can you hear me?
Yeah, perfect.
Yeah, okay. Very recently, I hear from the advisors of Christine Lagarde in Europe that in the future for the economies, the immigration policy is going to come as a very important factor in the economic planification. And in this country, we are always talking about that we blockade immigration because basically the great majority of the people are very low socioeconomic status and they don't contribute to the society, but at least in the short run, of course. But we have example, just a small sample, the Dreamers, 400,000 people over there were still discussing their status when all of them were educated in this country and they may contribute in a very short notice to our economy. Of course, not all of them are going to be trained in the Commonwealth corridor of Massachusetts, you know, but they are going to be educated here, and all of them obviously are going to contribute. They are contributing right now in taxes. In other words, my general question, Jeff, I'm not an economist at all, is do you think that in the future, the immigration policy is going to have a lot of impact in the economical policy?
In the US or in Europe or both?
in general. But
Yeah.
in particular, I'm talking about, again, the US.
Yeah, I think it'll have tremendous impact around the world. I think people that are anti-immigrant often, often it's as you know, out of nativist or populist or nationalistic fervor. It is true, if there's a country with high unemployment at a particular time, and there's a lot of immigration inward of unskilled labor, that would just increase unemployment. What we will face in the so-called advanced economies, the more mature economies of Europe, Japan, even South Korea, Australia, Canada, US, where we are facing a situation where we have increasing percentages of our population that will be retired. And the question is, who will be paying into the pension funds and into the Medicare schemes, the healthcare schemes, while we want to draw out, especially in the countries that have increasing life expectancies, as most do. Not ours because of our opioid crisis, but hopefully we'll get back to having increasing life expectancies. So most economic studies show that when you have immigration of skilled people, especially young people, they're a net benefit to the government budgets. If you look over their lifespan, they'll pay more in taxes than they'll end up drawing out. Skilled people and even unskilled people, first of all, maybe they'll gain some education, but we face situations where, to give you an example, if we didn't have any immigration from this moment forward in the US, let's say a Donald Trump immigration policy, based on the birth rates we've had up to now, our labor force would stay about flat. The millennials, et cetera, but the amount of people 65 and above will grow by 50%. It'll grow by 50% in, I think it is the next 20 years. So we would have 50% more people 65 and above with the same amount of workers. I think a little less, because our birth rate's been actually going down since about 2008. So without the infusion of some young immigrant workers or people coming into our universities and our grad schools and coming in and paying Social Security tax and paying Medicare tax, we would have to cut the Medicare that someone like myself would receive, that yourselves would receive, cut the Social Security. So anyway, that is what the studies have shown, is immigrants with some skills pay enough taxes that they may more than pay for themselves. Immigrants with no skills sometimes draw out more than they pay in a tax situation, but we still need them in the labor force. For instance, in hospitals and things, as our society ages. To put some flesh on that, right now we have 54 million people over the age of 65. We're going from 54 million to 81 million. It works out beautifully. I just did it in my head. It's going up 50% by 2040. So we certainly will need some workers, both to help take care of the economy and also to pay into things like the tax system. Thanks for that. Okay, what's the next one, Gray?
Thank you.
Malin DeLong is the last one with their hand up.
Oh, well, Malin, no matter when, I'll have time for Malin.
Good. Jeff, nice to hear your voice.
Yes,
and learning a lot here. The one thing that's kind of caught my attention recently, and it's a big one, funny one, which is the dollar's the potential weakening of the dollar, and what the implications of that might be. And I've even seen people saying there could be a rather major decline or fall. Is that something that we should worry about, or is there something that people can do about it in terms of investment strategies?
Yes, I'm glad you asked that, Doctor. And the first thing is, one of the things that drives exchange rates, at least in the short run, is the interest rate differential. What is the interest rate you can get on one of the currencies in that exchange rate pair versus the other? So as I showed on that one graph, Japan and the European countries have interest rates near zero and some negative, while
Right.
up until the pandemic, you could get 1.5% on the US, 2%. For instance, I had some money in a money market account, one of those online, FDIC insured, but online money market banks. I was using Ally Bank. People could use Citigroup or something. We were getting 2% on our money markets, as you know, before the pandemic. You couldn't do that if you had
Right.
your money in yen or in a European currency. So many people wanted to hold dollars. I don't mean just in the US, but around the world.
Right.
The interest rate differential truly favored having your money in dollars. You could earn about 2%. Then all of a sudden, when here you can earn essentially nothing if you put your money in a bank, or if you buy a bond that isn't risky. Like I said, a longer term bond has price risk. You buy a shorter term bond, the interest rate's almost zero. Suddenly there isn't that urge on behalf of people in Europe or in Japan or South Korea or Australia or Canada to hold US dollars. They used to have this urge because the interest rate differential was in our favor. They could get this extra interest, and now they can't. So, Doctor, I did that first to explain why the dollar came down. And now some people are thinking, well, if Chairman Jay Powell at the Federal Reserve is serious that we're just going to keep printing money, and he said we're going to keep
Right.
interest rates near zero, even no matter what happens through 2023, even if inflation goes over 2%. If it goes up to 3%, he said, no matter what, we're going to keep interest rates near zero. That has people thinking, well, there might be a lot of people around the world, a lot of investors who are going to think it's not that attractive to hold US dollars, to put our money into bonds or bank accounts or any vehicle in US dollars, because US dollar investments pay pretty close to zero interest. Now, it's true it's not negative, but you know, when you put your money in Switzerland, for instance, you feel very safe. So people felt like, well, they wanted a little bit of a positive differential in order to hold dollars. They felt safer maybe in Switzerland. So as long as the US has a higher interest rate, and if we don't have much of a higher interest rate, they won't. So there is a fear that the dollar may keep going down because Chairman Powell said, no matter what, we're going to keep interest rates low, even if there's
Right.
inflation. And in other words, there's going to be a negative real return on holding dollars. You're holding something that doesn't pay you interest and yet is getting eroded by inflation. And there's an excess supply of it. And you're always, you know, if we're having a QE infinity, if we're supplying an infinite amount of dollars. On the other hand, it's not clear that the dollar will go down further. For instance, the British citizens on this call, Gretchen and Jan, for instance, know that the dollar already has come down somewhat against the British pound. As you know, it's come down somewhat against the euro. It's come down even against the Canadian dollar. It's come down some against the Chinese yuan. With financial markets, usually when you start thinking about something like, gee, Federal Reserve might said they're going to print a lot of money, but the action happens right away. You don't wait for it to happen in the future. So like the dollar already lost a good deal of value against the euro. It already lost a good deal of value against the Canadian or the British. So it might lose more in the future, but it's not clear it will. It already lost value in the last 4 or 5 months because as the world realized, oh, the US is bringing its interest rates down and it's going to keep it down. So where do I end up, Doctor, is the idea that right now we're at a point of uncertainty. The dollar could lose more value. In that regard, if someone wanted to have a very well diversified portfolio of their retirement assets, they would want some exposure to assets that are non-US assets and non-US dollar assets. If we have a blue wave and if people fear that means too much spending or something and they get out of the dollar, well, then it's good to have some non-dollar assets. If Trump steals the election and the US becomes a mess, then it might be good to have non-dollar assets. So as each of you out there looks at your overall basket, you may want to say, I want some non-dollar assets. And Dr. DeLong gave us some reasons why. You know, we no longer have the advantage of a higher interest straight, we have a lot of what's called political risk. When you think about investments, you want to think about the political risk. We face an election of great political risk. So again, if I could give one urge to each of you, it's don't have all your eggs in one basket. It doesn't mean, by the way, don't have any money in stock funds. I don't want to tell you to in case they go down a lot, but most of you, as you know, you should have some money in a CREF stock account, a CREF global stock account, some fixed accounts, etc. I'm just saying, have maximum caution. And that's why I put the word uncertainty in the title of this talk. The interesting thing for people that are thinking about, you know, what do I want to do? Maybe some of you are not really retired. You know, people are beginning to think about having a home in Costa Rica, places where their currency has not gone up a lot. You know, if it's a place where their currency did go up a lot, like Dr. DeLong said, some currencies have already become expensive. A number of people are thinking, you know, Costa Rica is not a bad place to retire, or New Zealand. New Zealand's currency has gotten stronger as a number of currencies have gotten stronger against the US dollar, as Dr. DeLong said, but not that much stronger. You know, this is nothing political, I mean, but a number of very wise people are thinking, why not retire to New Zealand? Why not retire to Costa Rica? Just some place that has a good healthcare system. So in that regard, there are quite a number of places around the world where the purchasing power of the dollar is still quite strong. And you may want to study some of those, particularly the British subjects on this call. You have the advantage of the British Commonwealth. So I'm sorry I went on a long time. Dr. DeLong, I guess the final thing I want to say on that is, in finance, we have something called efficient markets, which you probably know about, but we assume that markets are efficient, that people are rational, and at least if people aren't Goldman Sachs's and Morgan Stanley, and they're going to move prices where they probably should be based on all the information we have now. For instance, if we hear that a vaccine is about to be developed, right away, people would sell stock in Zoom. That might sound strange to you, but Zoom, the price of Zoom stock, owning Zoom, has gone up 10 times. I wish we had thought of it, right? Here we are on Zoom. But all of a sudden, if there was going to be a vaccine tomorrow, a lot of people would get back in the classroom and back in office buildings, and business people would meet again. It wouldn't all be on Zoom. A lot would still be on Zoom. We found out how easy it is, but the price would go down. So in other words, markets wouldn't wait a week. If they heard, there's a positive drug trial, the price of Delta would go up in nanoseconds. Because even if we don't do something, Goldman Sachs is moving it. Why do I go into that? It's another reason why, as an economist and a finance professor, I have to tell you to diversify your investments. Don't put all your eggs in one basket. That the only thing that really makes markets move is unexpected news. If we hear good news about a vaccine, the companies that are making that drug will go up, Zoom will go down. If we hear bad news about a vaccine, Delta stock goes down, Boeing goes down, Zoom goes up. So in that regard, the only thing that really moves markets are unexpected news. It's when the Federal Reserve, for the first time ever, said, we're going to do QE infinity. We're just going to print money till the stock market goes back up. That's why, that was a surprise. Powell said, I'm just going to go wild. That's when the stock market hit that bottom and started going up. So the dollar, when it got that news that Powell's going to do that, as Dr. DeLong said, the dollar lost a lot of value. But now we don't know where it's going to go from here. It depends on any unexpected news that comes out. So what does that mean is don't keep all your wealth in the US, spread it out a little bit. But Dr. DeLong, if I could ask you, for those who would like to stay on, I don't know if you'd be willing, but you are the Alaska Award winner in neurology. Could you share some thoughts about this idea that COVID might have much longer lasting effects than a lot of people think? You know, it isn't just a matter of the president, for instance, saying, well, 200,000 have died, the others are cured, and it may have longer lasting neurological effects. I'm just putting you on the spot, but would you like to share any thoughts?
Oh, I'd be happy to, Jeff. Yeah, I'm not the expert in this field, but I do follow it, and I think it's a very interesting topic. Could I ask you one last question?
You can ask me as much as you want, sir.
Well, it follows up everything you've said, and it's trying to put it together a little bit. It seems like, you know, with the printing money here and the dollar and uncertainty and confidence maybe changing or waning, that the proportion of international versus domestic becomes a consideration. One of the things people talk about in being diversified. It sounds like it would be wise now to have greater than the simple formula that I've kind of been hearing with about 20% international and 80% domestic, if you want, and maybe way more some of the places internationally that you've mentioned that have particular strengths.
You know, I think it's quite wise. The problem is, again, because like I say, with the efficient markets, what really moves things are things we can't expect that, you know, I'm often wrong. So I don't want people to think I'm telling them
Right.
do a lot of international, but I think your reasoning is very wise. So let me say I'm aligned with what you're doing. It's even interesting. If you think about it, the US is maybe 20% of the world economy. We're 4% of the world's people with 23% of the COVID deaths, as you know, unfortunately. But most of us have 90%, 95%, 100% of our retirement wealth in the US, which is maybe 20, like I say, 20% of the world's economy. So what you're hinting to people is something I'm hinting to people. Neither of us want to be on the record. But the US, you know, we're facing, like I say, huge political risk, as you say, currency risk. I didn't even get deeply into the $26.8 trillion of government debt, which was 23 trillion in March. You know, again, the government is running this $3.4 trillion deficit. We probably have to because we're in a pandemic, but where does this all lead? Two other things I wanted to say before I want to come back to all of us taking advantage of having a great neurologist, which is, you know, if you think about something like a utility stock that pays high interest, high dividends, its price could go up and down. So I don't want people to call me in a month and say, you know, I bought some electric utilities, or I bought AT&T or T-Mobile, or, you know, some utility stocks that pay a high dividend. I bought it at 40, now it's 38. Just don't sell it. But one thing I've been doing is thinking is, if I was retired, or as I advised my mother, for instance, is like, if she needs to earn some income off her the little bit of wealth she has to retire, because Social Security doesn't pay very much, not going to, you know, the 0.1 or the 0.01 she's going to get at a bank is not going to pay any, that interest is not going to pay anything. Utility stocks do pay a nice dividend. And, you know, again, sometimes the price goes up. If sometimes people start thinking, you know, we need to earn some income. We're not earning it in interest in banks or in bonds. The interest rate's almost zero. You know, they might buy utility stocks or stocks that pay a nice dividend. The price might go up, but the price might go down. I can't predict that. But if you're not selling, it may not be a bad idea, people out there, to either buy a mutual fund that invests in a bunch of dividend-paying stocks. If you see a stock paying 10% dividend, run away. That means they're about to cut the dividend. It means it's a company in trouble. But there are some good companies paying dividends, 3%, 4%, 5%. That sure beats sitting around earning 0.01. I'm going to come back to Dr. DeLong in a minute. The other thing is, real estate seems to be a good place to be now. You know, if there's inflation, again, at least it's a real thing. I'm not saying you should become a real estate speculator, but I'm saying, like, if you own your own home, for instance, it does seem to be, over long term, it's going to be a good store of value, and at least you're not paying rent. Or if you were in a REIT, which pays a REIT, a real estate investment trust that pays some return, or if you're in a financial position that's pretty strong and using some friends or some family members, own some rental real estate in a place that's an advantageous location. It does seem like real estate is a good hedge if we do have some inflation. Remember with the very first excellent question I was asked about, if we keep up with all this money printing, we do have a finite amount of maybe very good real estate. So I would ask each of you to maybe look at some dividend paying stocks. Beware of anything that pays a super high dividend. It means it's a bomb about to explode. Now we'll come back to the neurology. Sorry about that, but I wanted to give something practical. Gretchen?
Yeah, hey Jeff, I just had to unmute myself.
Sure.
You've been so generous to take us, 18 minutes past our end time, and obviously we don't want to let you go. Also, I should say, obviously, it's clear to all of us here today why you're considered one of the 12 best business professors in the world. It's just been a wonderful session. And if you're willing to hang around for a little more chit chat, but
Sure.
we probably should wrap it up and go
Sure.
to gallery view, and maybe Greg can unmute everybody. But if you need to go, Jeff, you can go. And if other people want to continue making comments,
First,
asking
let's see if
questions.
Dr. DeLong, we'll see if Dr. DeLong is still on.
Yeah, I don't see him on the list.
So Malin is here.
I'm sorry, I'm on.
Okay, he's on.
Yeah, because I think
I can say what I can say is very short. This is people have been looking at this as a pandemic, which is like the typical viral infectious disorders that spread throughout the world. But the latest twist on all of this, taking into account what we now know, is that this is particularly a problem for people with pre-existing conditions, diabetes, cardiac, obesity, all kinds of predilections, socioeconomically driven to some extent. So the concept of this not just as a pandemic, a viral infection, particularly affecting the lungs, but involving multiple systems, and particularly people with pre-existing conditions. So it's a kind of like a systemic and pandemic, or a syndemic disorder. And it's a very interesting concept, I think, and it suggests that there are important differences in people or particular populations that are extremely important, and a broader focus on this disorder, because there's never been anything like this. And the evidence is compelling that this now is a viral, or is a diffuse vascular disorder affecting blood vessels everywhere in the brain. We know there are neurologic problems that are associated with this now: kidney, lungs, heart, and autoimmune disorders. So it's a very complicated virus that has broken through all the barriers and producing a very, very serious problem, which is not going to go away right away. That's the problem.
Yeah, I don't think we know what all those long-term effects are. I mean, we have all these young people. We have all these young people getting infected, and many of them, we think they're all fine after a few weeks. But now there's hints starting to come out of long-term damage, and that part of it is on top. I'm an epidemiologist, but I don't specialize in infectious disease. But just knowing typical epidemics like this, once that cat is out of the bag, it's a 2-year cycle. In terms of my own investments and everything, by early March is when I was really concerned, because it was clearly out of the bag and rolling. And we knew it was going to be a 2-year fight. And this notion of shutting down for 6 weeks and being done with it, the epidemiologists all knew that's not how it's going to go. And now we have this second thing that you're cueing into, Jeff and the others about these long-term health effects that we don't really know.
Yeah, exactly. Yeah.
And you know, what's interesting about that is when we think about the investment implications, like Alex said, as an epidemiologist, he knew right away this wasn't just going to be some simple thing. So when the stock market went down 34%, which makes sense, you know, we've got this problem, and then it goes up and hits new highs, it's crazy. So I certainly was watching it going up thinking, yeah, even with the Federal Reserve putting all this money in there, are people truly underestimating how bad this pandemic is? And as Alex said, how long it could take for this to unwind. And again, as I said, with efficient markets, no one really knows where things are going. But I would urge people on the call not to get over optimistic, let's say with the stock market investments, just because a lot of people feel like, well, it's going up, it can only go up. I think what we just heard from two great experts, Alex and Malin, in different fields, but great experts, is there's a lot of bad news that still might come out, and that's going to impact the economy. It's going to impact the ability of corporations to make profits, of people to go to work, maybe people to go to shop, or to ever go back to theater. So this does all intertwine. Malin, what you said, even though it and what Alex said, it's not something that makes me an optimist. It makes me feel better about a decision. At the business school, they ended up giving us a choice. Would you like to teach on campus? You know, you have a face shield, or do it through Zoom. I was going to do it on campus. I love to teach. I love that engagement, as Gretchen hinted. But when I heard about what Malin just said, the systemic effects and the neurological and as Alex said, the fact it can come back and the long-term effects, I'm very glad I'm doing it through Zoom. Maybe it is a conclusion, Gray and Gretchen. We'll see if anyone has a final question for me, but maybe better, this is what I'll do. And I may come back on, I may see you again. The program on sleep sounds fascinating and some of the others, but I'd like to offer three things in one. One is, you all are extremely brilliant people. Many of you are still working and keeping up with your own research, or most of you are, or if not, you're what we're counting on in the US, educated citizens continuing to advance themselves. Every one of you, if you have a pen, or I could just send it to Jan, should read The Economist. You can either get The Economist magazine, there's an academic rate, and if you're an emeritus professor, you still get the academic rate, or just go to economist.com. That comes out once a week, but economist.com always has new things. Again, it's not for economists, it's for you, it's for intelligent people. You should always go to CFR.org, Council on Foreign Relations. It's got the short articles about what about Syria, and what about North Korea, and what about Biden, what's he doing here, and what about Boris Johnson, and what is Trump doing with you know, some autocrat somewhere, and what are some experts thinking about, what is the national security implication of Trump owing $400 billion to, you know, Putin or something. So that's CFR.org. It's free. I'm trying to give you free sources. And I'm going to send, I'm tailoring it for you. I'm going to send to either to Jan. I've actually taken the time to make a list of sources, all free. Are you interested in demographics? I talked about demographics. What populations are aging? Are you interested in some economic data? Malin brought up exchange rate data. What if you want to get your hands into some exchange rate data? Look around, economic data. You're all brilliant professors. So I felt like maybe I, as someone who can help curate economic, financial, demographic, and geopolitical sources for you, since I run that program for business and public policy and government, I hope that will help you continue your own intellectual development, because as a society, we really need it. And I look forward to continuing to learn from people like Alex and Malin and Gray and the rest of you. So I'll send that along. Otherwise, I want to thank you, those of you, the few, the brave who stayed on.